Hey viewers, this is going to be a review of portfolio position for one of my TSP group members named Valetica. Uh, Take a look at these. There's four stocks that were mentioned to me. Take a look at them. I'm not familiar with any of them, to be honest with you. Maybe the first one, but I don't know if it's the same company. But I'll just kind of take a look at you know whether what I think of each of them, whether I like the company in any way, and or whether I don't like them. What kind of investment strategy I think would be. I mean, they seem to be more ideal for. Um, so here we go. First one that was brought up was CMRX, which I believe is Cimerex or Shimerex, whatever. Biotech company. Okay, they reported a loss of earnings in the last 12 months. That's a red flag there to me. Doesn't mean that it's a bad thing, but when I see usually me personally, I won't go near companies that have that are working underwater. So this right off the bat, I would be saying this would never touch my portfolio. Also, another thing here that's near the 52-week low. Just about right at it, actually. So, uh, generally, I wouldn't want to go near companies that are near their lows either, unless I can see that their earnings are going to turn the corner. Because usually when a company's at or near its 52-week low, it's going to keep going further and further down until there's some kind of catalyst to push it back up. Usually, if this is going on, there's probably an earnings problem too. In contrast, if a company's at or near its 52-week high, it's actually more likely to see more gains because it's already in the it's already seeing conditions that are more ideal to its growth. So this is one of the differences, I guess, with the way a lot of people might view stocks. Okay, now I don't normally look at PE ratios. I'll just kind of mention it. Yeah, a lot of investors do look at it, but I don't personally care for it as much. Now, from that, keep in mind though, I'm a much more macro-oriented guy who has a much more top-down look at stocks than I do just picking something that interests me and really scrutinizing the micro stuff. Uh, of course, your average novice or know nothing investor won't know any of this stuff, which is why I'm also making this video. So some of you can actually learn a little bit more about what some of the things to look for and get some ideas on just what kind of warm, fuzzy feeling you might get about a particular stock or whatever. Um, Keep in mind though, some of these stocks, it might not be the wrong stock. It might be a great stock for you, but sometimes if you're looking to buy something, it just might not be the right time to buy it. It might just, maybe the economic conditions are not ideal for it at the moment. Maybe you're looking for dividend growth when it doesn't pay a dividend, like this one here doesn't. Or maybe you're looking for share price growth, but you have something that is more stable and set up for dividend payments. Uh, Never know. So it really helps to understand a lot of these things going on here. Okay, so as I mentioned, this thing here doesn't pay a dividend. They have a 1.2 beta. Beta tells you how volatile the stock is compared to the S&P 500. Now, 1.2 is slightly more volatile, not that bad. As you can see here, though, in the 6-month price chart, it did spike up almost 25% in price there at one point, but then it came back down. But aside from that little spike there, it looks fairly consistent with in terms of volatility, in terms of what I would expect a individual company stock to do. So this does seem to be a pretty good representation of what I'm looking at here. A lot of investors don't like high beta stocks because they're just too volatile. The price swings are just too wild. Um, Most of us, like let's just face it, most of us like to have we have that addiction to watching our account balances grow, and anytime our account balance goes the wrong direction, uh, it scares people and makes them wonder what are they doing wrong. It's not necessarily anything being done wrong, to be honest with you. You never know. Um, it could just be the inherent volatility of the stock, but you might have the right stock and have it at the right time, but it's just going through its regular ebb and flow, and it might be a lot more wild than. So just keep that in mind. If you're not very tolerant of risk, you can't handle the fact that like stock prices are for individual companies are pretty wild sometimes. You might want to stick with some of the lower beta stocks, something closer to 1.0 or maybe even a little less than 1. 1.2, it shouldn't be a problem for most people either, but now there are some you're going to see that are like 1.5, even 2. I even looked at one yesterday, it was a 2.5 beta. Yeah, it's just really wild swings. Something higher beta like that, I don't think would be such a great idea for someone who's looking to hold for at least a year, but for somebody who might be more interested in playing a short-term game, you might be able to benefit more from it. Because, I mean, now I'm not talking about day traders either. Yeah, day traders possibly, but I'm talking more about swing traders or position type traders, where maybe you want to hold something for anywhere from a day to a couple of months or something, where you have some patience and you do expect that it's going to have some kind of wild price swing within a certain time, and you can get something out of it. But so, like I say, there's so many different stocks out there, but not everything is the right fit for for each investor. It's not a one size fit all thing. You got to consider your own strategy, what your own time horizon is, what you're looking for, how long you want it to take to get what kind of growth. A lot of different things, so keep all these in mind, okay? Looking at the other parts of this one, over 80% held by institutions. That's a pretty decent amount. I've seen higher. They do get up into the 90s, but 80% is pretty decent. And for a company that's only got a $203.4 million market cap, that's actually not bad at all. I mean, because 203.4 is not that big. I think it's kind of right on the borderline of small cap and medium cap, if I'm not mistaken. So for 80% holding by institutions for a company that small, that's actually a good sign. So that could be a good thing for us. Short interest. This is also pretty low. You can see these get up to like 25%, even higher sometimes. So, not much short interest in this, which means not many people are betting against this stock right at the moment. Okay, something that's important to look at is earnings growth. For a dividend stock like this, or for a non-dividend paying stock like this, you want to see dividend growth. It's earnings growth, because earnings growth is what's going to drive your share price growth. Or even if there's not if there's not earnings growth going on here like you see right now, there's nothing to make me want to touch this company. Looking right here, then I'd be wanting to look at the fundamentals and see if there's something going on there that makes me think that they can survive this long underwater and maybe have something coming up. Now, the biotech company, a lot of times you're dealing with somebody who has drugs that are not available to the public just yet, and they have stuff going through clinical trials, and all they need is FDA approval to start actually generating revenue from it. So this is one of the biotechs are inherently risky. They're actually biopharmaceuticals. They do come with inherent risks like that. So me personally, I'd prefer to stick with a company. If I'm going to go in this sector and group, I I would stick with a larger company like an S&P 500 company, somebody who already has a line of products or medications or whatever available that they can actually generate revenue and income from. But so far at the moment here, I don't see anything really here that makes me understand why this is 80% held by institutions and not much short interest going on here. But I always want to compare these against the same quarter of the previous year. So you got quarter one here. They reported a loss of 42 cents a share. The same quarter last year, they had lost 38 cents. So they're in worse shape now than they were last year. Now, if we keep going back, they lost 41 cents there, and they lost 32 there. That's a negative there. Lost 37. Okay, so they matched what they did the previous year there. Lost 36. Lost 39. So it was a slight improvement there. Now, one thing I will say that is a good positive sign here is over the last 2+ years, most of these quarters they've done better than expected with these earnings. As you can see, they got the green plus signs here that tell that they beat estimates. And I can't move my mouse to it, but as you see here above it, non-GAAP actual reported was minus 57 cents here in this quarter, and the consensus from the analysts was negative 66 before they reported. And now they have 7 analysts here too. It's for a company this size, it's not bad. So again, I don't know anything about this company, but I'll look here at the company profile, maybe get some more ideas about them. But I want to look forward too. If there's no dividend, then there's got to be some kind of earnings growth there to expect the price to go up. Okay, so they're expecting a negative 44 next quarter. They reported negative 36, same quarter last year. Now, the reason why you want to go against the same quarter last year then is because companies tend to be cyclical with their earnings. I don't recommend comparing from one quarter to the very next quarter. So 42 versus 41. That doesn't tell you anything, because how does this company operate? They could be like an H&R Block type. Or I'll pull up H&R Block so you can see. Okay. As you see, H&R Block on a yearly basis, they have 3 quarters in a row where they work in the red. And then fourth quarter, which is their tax season quarter, basically, they report strongly positive earnings that actually more than makes up for all of the losses they make the rest of the year. So the same thing here. All these previous years, you got three quarters in a row that are bad, and then the end of their fiscal year, they report strongly positive. 3 bad quarters, 1 positive. 3 bad quarters, 1 positive. So you can't really gauge how well this particular company is doing unless you're going to go by year over year. So this is a great example of why you always want to look at year over year performance. Okay, going back to Cimarex. Take a look at the fundamentals here. Okay, company is focused on discovering, developing, and commercializing medicines that address unmet medical needs. Lead compound, for instance, Dofavir, is in development as an oral and IV formulation for the prevention and treatment of DNA viruses, including smallpox, adenoviruses, and human herpes viruses. Okay, so like I was saying, with no earnings at all there, I assumed that these guys were probably pre-FDA approval kind of company. At least this one is a little more broad. It sounded like it could cover a more broad market than the last biotech or pharmaceutical company I just looked at yesterday for somebody. So there is a better prospect there. Okay, we'll move on here though. Now they're pre-revenue, so I'm not surprised seeing this thing going on here. Just take a look at I'm not going to go as deep into this balance sheet, income statement, and cash flow stuff as other people will. I have a really good idea what I'm doing with this stuff, but like I say, I'm not so focused on the micro view that that a lot of the more professional investors are. Like I say, I take a macro perspective, which is you don't find too many investors doing. Okay, so assets, cash and short term, they picked up. Yeah, they picked up quite a bit over the middle 3 years there, but then they're coming back down. Yeah, which is also seen by this chart here. Their debt, though, that looks good. Looks like I don't know why their debt's gone down when they're pre-revenue. Loan forgiveness in return for equity into the company. I don't know. Total equity, it went up. Yeah, peaked in 2015 and is slowly coming down. Well, for a pre-revenue company, that doesn't really surprise me because they're burning money. So then they don't have any debts at all. So this is actually a positive sign, even if they go. Look like if they keep going at this pace, they might be able to go several more years before they run out of assets and have to go bankrupt, possibly. So that looks kind of positive there. Okay, they do have looks like they have a lot of construction going on here. Buildings, their value of building assets has gone up over the years steadily. Except kind of more flat lately. So that's a good sign. Machinery is also going up. It's flattened lately though. Same thing going on here with other property, plants, and equipment. So these are all positives. Look like they're expanding. Now it's just, like I say, if they can get FDA approval, they might possibly worth keeping. Okay, now liabilities. Now let's look at their total assets. Right now at 235 million, is it? Yeah, 235 million. Okay, total liabilities. They got, no long-term debt at all. They had it at the beginning of beginning of their existence. I assume is at least maybe they've been around longer. I don't know, but they don't have any debt. That's going to help them. Their total liabilities has actually gone down now. It actually went up the most recent year, but it's still down compared to what they were in 2013. So that's a good sign as well. The total assets has gone up more than double, and liabilities has gone down. That's actually a good thing for their total equity. As you see, the total equity line here is basically a measure of what I just told you right there. The total assets, subtract the total liabilities, and this is what you get right here. You see, they were just under 100 million in total value in 2013, and they're up to over 220 million now. So again, that's a positive sign. They go into their income statement. They actually do have some revenues here. Okay, did not expect that. Alright, so I'm going to just kind of look at these instead of down here for you. Just kind of get a better idea. Like I say, I don't take such a micro view, and I don't want to have this video go excessively long either. So I'm just going to go skim over a lot of these basics here. Okay, and operating income it's in the negative, which we already know is going on, but it looks like they're improving a little bit. Same with total net income. And I see total operating income and total net income both doing the same thing. It tells me their margins are probably staying consistent. They're not getting worse with the margins. They're not getting necessarily better. So, it seems like they have a pretty good handle on their expenses, their operating costs. All right, total cash from operations. Well, we know they're in the hole. They hit their lowest point in 2015 again, and are going back the other way. So that's again, this is a positive sign here. The question is, how long can they stay in float before they run out of money and assets? Um, at least they do have some revenue to help them out with this. Total cash from investing. Sometimes it does help. Sometimes to look at what kind of investing they got going on, like short term and long term. Sell maturity of investment. So yeah, they've actually grown there. That's good. Purchase of investments. So they've actually spent a lot of money on investing. They spent a lot here in the middle years, 2014 and 2015, and then kind of slowed it down. So all in all, this man it looks promising. It's not one for my portfolio personally, but and it's not one for somebody who has a shorter term view of what they're looking for. If you're looking to day or swing trade this or get some kind of results in less than a year, this is probably not the right one for you. But if you're looking for like a much longer term view, this is a possible one. I wouldn't put too much money into it, but I would put like a smaller amount of my investment capital into something like this, and know that over a much longer period, like maybe a 5-10 year or whatever kind of span, there's a pretty decent chance they're going to do something for you. So keep this in mind. Vodka, I don't know if what you're looking for, if this fits your philosophy on what kind of companies you really want to be holding on to, but that's my thought on this. This looks like more of a long-term hold than anything. Alright, let's look at insider buy and sell stuff. That's a lot of insider activity there in the last quarter. All of this is just within the last 3 months. Look at the more recent ones, the June 21st ones. There's a lot of those. Now, clustered buy activity can be a good sign, but cluster sell activity can also be a bad sign. So these are a good thing to look at. What kind of consensus do these insiders have? These could also just be options, though. Okay, these are derivatives. These are options. So I'm more interested in what's going to show up on this line, and I'm looking more for something right here. It says it's acquired and an actual price than anything else personally. So see, this is stock option, right to buy. So more than likely, all of these are probably going to be the same situation here. Yeah, that's also an option. You generally see these more often when the company reports earnings or at regular quarterly or semi-annual kind of intervals. Okay, yeah, these are all options. Alright, so that's enough on that one. Okay, so now looking at the industry here, biotech. I'm more of a macro guy. I like to look from the top down and see what the whole group is expected to do, because one thing a lot of people don't consider is the fact that a lot of companies, individual companies, get impacted by what you call the ETF effect. ETF effect happens when another company in the same group, maybe they have some bad news or good news, whatever, it can impact the whole entire group. Also, and part of that is because when a company, let's just say a peer company reports something bad, then it's kind of like an omen of what's going to happen with the rest of the industry or sector. Because there are a lot of sector-wide influences that impact everybody within a certain group. So that's one of the things one of the reasons why I like to look at the take a more macro look at things. But just to show you my perspective on this, Biotech, I'm going to show you where this is at. Okay, healthcare is where Biotech's a healthcare stock. 11% growth for the whole healthcare sector over the next year, at least for S&P 500 companies. Several that are better. I don't have this sorted in a way where you can easily figure out where they rank. But I tend to like looking, or I can look up here because I still have it in here. Healthcare is number 7 out of 11 sectors, though. So as you see, Infotech is in the middle of the road. Right now, Infotech is expecting 12.2% growth as a whole sector, but right now, my numbers for the S&P 500, I'm expecting about 15.5% growth over the next year. So everything below industrials, I'd be a little more concerned won't perform quite as well as putting my money in like an S&P 500 index fund or something. Anything above it, I would think there's a better possibility that I'm gonna get better performance out of my position than the S&P 500. So I'll look more at that. Okay, but coming back down here, let's break this healthcare sector down. Let's shrink this down some more. Too many to look at here because, let's say, sometimes there's these. It's better to look in terms of groups, in my opinion. It's because whatever happens with one company in a group, you're likely to see with all of them. Okay, there's basically two subsectors in the healthcare sector. You got healthcare equipment and services, and you got pharmaceuticals, biotech, and life sciences. Right now, it looks like the healthcare equipment and services is in a little bit better shape, but both of them look okay. Just like I said, neither one of these as a group looks like they're expected to do enough to really interest me at the moment. And again, there are a lot of good stocks in the healthcare sector. Just right now, not the time where I'd be so interested in buying into them at the moment. I don't want to see their earnings actually pick up the pace where they're one of the stronger sectors and not weaker. But just to give you an idea, Biopharm. Okay, so this is a biotech company. It's going to be in this group here. Okay, so out of the biotech, let's see, you got these three here. Okay, they're all very similar in what they're expecting, to be honest, though. Life Sciences Tools and Services Group, it's a little bit higher, but Biopharm is right there, so might not be bad. And this is kind of how I wrote my screen, say if I was looking at biotech. And actually, it's funny I bring this up because AbbVie is one. AbbVie, ABBV here, is actually one company I've been looking at, possibly buying before long, despite their group not being so strong right now. But financially, I really like what I see when I'm looking at them. Their information that I was just showing you with Chimerix. But this is kind of how I run my screens. I like say if I wanted to look at biotech, then I'd have this group to pick from, and then I'd figure out which one looks like it's going to do the best, or I'll pick the ones that are expected to do the strongest growth. This should be showing stuff here. It's not though. There we go. Okay. So, like right here, I can see that Vertex and AbbVie are likely the stronger performers. So, if I was looking to buy a biotech stock, and I'm one who only likes to invest in S&P 500 companies, those are the first two I'd actually look at, and I'd compare them against each other and look at all their data on the Ameritrade site. But I already know I haven't looked at Vertex, But I know from looking at AbbVie and comparing them to somebody else, I really liked what I saw with AbbVie. So they're definitely one I would look at if for biotech. So yeah, again, as a whole sector, I wouldn't expect anything special out of these guys. But man, like I say, it's Shimrex does look like it could be a good long-term hold. Okay, let's see this next one. Xxii. No idea what the 22nd Century Group. Tobacco company. Okay, small cap. Yeah, 305 million market cap. So they're kind of on the. They're also on that borderline of small cap and medium cap. They're also closer to their 52-week low. That's a negative there, or a yellow flag, I should say. Earnings per share trailing 12 months is also underwater, so that's another yellow flag. They don't pay a dividend. That's another yellow flag. Now, beta. See, now I was talking earlier about beta. See, this is a 2.3 beta, so they're more than 2 times as volatile as the S&P 500 is. So right here, just looking at that alone, they're definitely not a company that would be an ideal choice for somebody who can't handle large price swings. So keep that in mind if you're looking for something that, you know, it's not so wild. This is definitely not a good choice for you. But if you're looking for a shorter term, something shorter term that you can make some quicker possible profits out of, this, pick and choose your times right here. You might be able to get something decent out of it. And as you see here, it does spike up over 10% sometimes, or did once at least in the last 6 months, and then fell to more than 20% down in May. But it's back up to looks like about 7-8% positive. And this, so from negative 23, let's just say 24, 25, maybe negative 24%, up to about plus 7%. That's a pretty nice jump there, and that's on only a 2 month time span too. So again, this is a good example of where these higher beta stocks are better for a short-term player than a long-term player. So looking at just these two already, between Shimrex and 22nd Century, it's a tell of 2 totally different companies here as far as what kind of investor should be playing with them or putting their money into them. This is definitely a short-term hold, and Shimrex is definitely a longer-term position. Now also look at this here, percent held by institutions. It's much lower, down at 22%. It gets lower than that, but this is fairly low. So not much interest in this company by institutions. Short interest is a little higher. Like I say, it's not uncommon to see companies short interest get up above 20 and even higher. So it's not bad, but it's definitely not good either. Again, it's all just plays into, this is a better company for a short-term player than a longer-term one. Earnings information. This is a big red flag to me. If they don't have any analysts looking at them, that's usually an instant I'm not interested. Now, you can do your diligence and actually pull up the company's 10Q and 10K filings, which now if you're an Ameritrade user, you can actually look here in the SEC filings. You can also go onto the company's own website. Usually they have an investor relations page that you can get the information from. And also the SEC itself has its own web page that you get any company's filings from. But in terms of when I'm screening for something, if I have to go digging through 10Qs and 10Ks to get an idea, sorry, they're not worth my time. I want to, when I'm screening, I want to get a real quick idea whether I'm going to have any interest in looking deeper or not. I shouldn't have to go looking deeply at them to figure out if they're something for me. Because I do tend to like to have a more, at least a 1 year position, and that's because the tax benefits. If you hold on to a stock for at least a year, it's going to give you, if you hold on, if you sell any of the positions and you hold them for at least a year, that's considered a long-term capital gain. And a long-term capital gain is limited to a 15% tax assessment. Short-term gain, on the other hand, is basically a position you hold and sell for less than a year after you bought it. Those are considered short-term, and those are different. They are subject to the same. Basically, put it the simple way is they're taxed the same way your regular income is taxed. So if you're in a 75, let's say a 28% tax bracket, for example, then you're going to get taxed 28% of your gains from that. And you want to consider that too as part of the cost of owning this stock. You don't want to sell stuff too quickly and then not have many gains to report, and then what gains you do report just gets eaten right up in taxes later on. Then you're really not doing yourself any good. So that's one of the reasons why when I'm playing with individual companies, I'm not inside a tax qualified account like my TSP account, or if maybe you have an IRA or a 401k, 503b, or whatever other kind of employer or tax qualified retirement kind of plan. I strongly advocate trying to stay in the positions for at least a year so you can take advantage of those tax benefits. Not to mention, after a year, you get a better opportunity to get some actual share price movement, hopefully in the right direction. If you're looking at the right things, and you should get the right kind of movement if you know what you're looking for. If at the very least, get your dividend yields and then just keep holding on long term by dripping. That can also pay off. Okay, so let's move it on here. I'm going to go a lot more quickly at this area than I did to the last one. Now, they do have pretty strong revenue growth. That's a good sign. Cash and short term wasn't very much over the last 4 years, but then they shot up. Total debt. This looks good here, actually. Went from not too high to they took on a lot of debt in 2014, but it's shrinking down, and it looks like they don't have any anymore. So that's good. They got their bills paid off, and their total equity just that looks great. Has gone up quite a bit here. All right. Just take a look at their total equity here, just how much different it is. Okay, $7 million in equity back in 2013, and they are up to $75 million. This is nice growth here. So I can see why this one would interest some people. Again, it's not one for my portfolio, but I do see things that I can see why some people would have an interest in these guys. Okay, looking, they just reported earnings they reported in May. You're going to see another 10. They have a 10K, which was their end of their fiscal year report, in March. So since they reported in May and it's now early August, they're probably going to be reporting earnings again anytime now. I'll take a look at that again real quick, but there's probably going to be another 10Q coming up here really, really soon. Last month there was a single insider buy or sell. It doesn't look like much there except for back in April. Just curious what this is, though. Okay, now this person's still Thomas James, Vice President, General Counsel, and Secretary. They actually sold off 50,000 shares, 243. So, it's at $120,000 worth of shares, something like that. Somewhere in that ballpark. He sold off. It's just one person selling. Not really necessarily any kind of problem there. And you see he does have options to buy as part of this too. So he might just be looking for something liquid for his personal needs or something. Who knows? Let's take a look at a couple of these other ones. Okay, now this is a sell. It's quite a few shares too, but there's no price. Okay, it's President and CEO. Okay, again, that's one selling. That's James Cornell, he's a director. That's another sell here, Joseph Dunn. But again, there are no prices mentioned in here, so this is a cluster sell, as I'd call it, and usually that's something that would be a concern. But these don't appear to be open market sells, so these look like they might be like pre-planned or something. Again, I'm not an expert on the Form 4 matters, but I can tell you those are all insider sales there that I just looked at. And normally what I do see is I'll actually see a share price of it, when I see a share price, I think it's usually an open market. So yeah, these are all just. It does look like a cluster sell, but I'm not sure it's something that I'd be overly concerned with. Okay, so allows increasing or decreasing the level of nicotine and other nicotine alkaloids in tobacco plants and levels of cannabinoids in cannabis plants through genetic engineering and plant breeding. Okay, so Radhika, I'm gonna guess that you took an interest in this because of their cannabis involvement. Marijuana industry is a very popular industry for newer investors. Newer investors like to do tend to heavily favor the more speculative type of stocks, and anything in the cannabis industry is a more speculative play at the moment. There are some states like my own state of California, Oregon, I believe Nevada, Colorado. There are several states that now allow recreational marijuana use, and it's widely believed that an increasingly larger amount of the country is going to do that. Which that is a good reason why there's a lot of speculation there. But yeah, when you get speculation, you're going to get a lot more volatility in the prices as well. Yeah, in the shorter term, and there's always that possibility that the speculation isn't going to pan out to what it was expected to be, and then you end up eating a big loss if that does happen. I don't really think that's going to happen with the marijuana industry. So I do see this as a longer term speculative kind of play, not something for somebody who's looking for something more established, that they can more easily trust is going to perform well over the years. So like I say, I can see why this would be in your portfolio. This is another one where I wouldn't put too much money into it, but I don't really see anything necessarily wrong with holding on to it either. Okay, Neos, that's your next one. Neos Therapeutics, that's a pharmaceutical company. Again, we already just talked about the healthcare sector as a whole. Now, their price is just going down. That's 40% down in the last 6 months. That's just nasty. I can see why you lost money with them. You had identified to me that Xxii and AKF. The next one I'll be looking at are the two that have made you money. Neos, they don't look good at all here. Now let's just figure out why. Okay, they are another small cap company, $168 million market cap. They're not quite to the level where they're worth being called a mid cap. They're Okay, 580 right now. Their 52-week low is 530. They're right near the 52-week low. Again, that's another not good thing to see. Okay, earnings per share. They're in the hole again. Like I say, me personally, anybody who's in the red, they're not going to find a place in my portfolio. That's just me, though. Like I say, I only invest in S&P 500 companies, which are large caps, and I'll only touch them if they have positive trailing 12-month earnings. They also pay a dividend, and I also like to see earnings growth out of them. That's kind of like my trifecta. So this is already just instant. They'll never find my portfolio. But again, that's just my personal philosophy and way I invest. And like I say, this you saw from the previous two examples there. The last two stocks you had in the position there were. I can see why they're good, reasonable stocks to have in certain types of portfolios. So I'm going to go through this and do at least some diligence here and figure out what's going on, and give an idea if they give me kind of impression of what kind of portfolio they might be good for. Now, they don't have a PE ratio because their earnings are negative. And like I say, I don't like to look at PE ratios like everyone else does because there's so much going on there. PE ratios, they're always so generic in what is brought up. Okay, is it trailing 12-month earnings or is it forward 12-month earnings that they're going by? Is it GAAP earnings or non-GAAP earnings they're going by? And usually you only see one and not both. And if you're going to look at PE ratios at all, my opinion personally is stick to the same standard. Stick with GAAP or non-GAAP, not both. And then if you're going to look at it all, look at both, trailing and forward earnings, not just one or the other. Because just looking at one single type of PE ratio is not giving you anywhere near enough information to work with. Also, if you're going to look at PE ratios, compare them to other companies in the same group. So with Neos, you'd want to look at other pharmaceutical companies. And even more so, you might want to look at other small cap pharmaceuticals. Don't try to compare a small cap pharmaceutical against an S&P 500 large cap pharmaceutical. You'll probably get different, you won't get such a great comparison because an S&P 500 company is a well-established company, and one like this is not so well known. Okay, these guys do not pay a dividend, so again, if they aren't going to pay a dividend, I'm going to expect to see earnings growth. Percent held by institutions, 56%, so they're in better shape institutionally than Xxii was, or 22nd century, whatever it was, but not as high as some other companies like Chimerex or some of the other larger companies. Short interest, not super low, but nowhere near high either. So I would expect to see some volatility there. There's no beta in there, but and looking at their price swings, their price behavior here, it's hard to gauge because they've gone down so much over the last 6 months. It's hard to see, just get a better idea of just how large these other swings along the way are. They don't look like they're a hell of a lot though, except for this one here in the first half of March. So my impression is they're probably not that high a beta stock. Okay, now let's move on to earnings. Okay, they're in the negative, but I do see some potentially positive things. They have 6 analysts, which isn't bad. Some of these smaller companies might only have a couple of analysts, and some of these don't have any of them that'll give you information here, like Xxii, I believe. They didn't have any analyst estimates information in there. This is why their chart didn't show up in here for them. So these guys do have more analyst coverage, so that's a positive. Okay, so their last report was a loss of 50 cents a share compared to the same quarter last year was negative 87. So this is better. Let's look at their history now. come back here, 87 to 79. So they lost here, but then 83 from minus 165. That's really good. And this was a miss. They did have a history of misses here with some beats early on, but look like they're finding some footing here. So I'm seeing more earnings beats now going on here. It means they're probably doing a fairly effective job of managing themselves. Okay, 58, a negative 58 compared to negative 161. So they are growing. They are moving in the right direction. Negative 49 from negative 114, and these are, like I say, 3 beats in 4 quarters of that same fiscal year. These are all good signs. Okay, negative, and the forward earnings estimates now. I got negative 44, which is about about twice as good as what they had last year. Negative 36, compared to what they last did was negative 58 here. So these all look good. This does look like their earnings are getting better. So there is an argument that their share price should recover, but when they drop 40%, I really would wonder what's going on with them. There might have been some kind of news that came out or something, or maybe they're just not getting enough exposure. These are all zeros, so I don't know if these are actually if these are actual analyst estimates that they'll actually be flat that year, or if they just didn't really project out. But usually you won't see anything in there at all if they just aren't projected out far enough. So I would take a guess that they're expecting them to break even, just barely break even next year. So this looks like another one that could be a long-term speculative type play. Let's take a look at the fundamentals. Okay, cash and short-term investments come down a little bit, and then they spiked in 2015, and then they dropped and came back up. Total debt, they're picking up debt though. And total equity, see, they spiked when they had their highest short-term in cash, but then they went underwater in 2016. That's not good. They've gone up a little bit in 2017. They do have a lot of inventory of finished goods, so when their inventory is growing, now there are 2 things that could be going on here. They're either expanding where they have more labs or whatever that they are producing from, or more real estate that they could be generating revenue from. That could be part of it, and maybe it's just in the process of getting sold. Or it could also be that they're picking up and on finished goods, then not able to sell it because nobody's interested. Or, of course, with a pharmaceutical company, it could be they have stuff that's not FDA approved yet. They have a lot of work in progress. It's picked up. So I'd like to think this is expansion, but I don't know. Raw materials is also picking up. Total inventory, as you see, is up a lot. So, like I say, this is stuff you'd want to find answers to. Why are their finished goods going up? You don't want to have inventory sitting around not making you money. If it's just sitting there as finished goods, you want to convert that into cash, not have it sitting around as finished product. So, like I say, take a look at their 10Q and 10K filings, their earnings conference calls if they have any, and maybe get some better ideas on why they have so much more finished product. Because if it sounds like they're just having demand issues, then I would dump them. But if it sounds like they're expanding, then that could be a good sign there. Total current assets has gone up. But here, look at here. Buildings. I haven't really done much with buildings. Maybe they can. Of course, I don't think a pharmaceutical company would necessarily need more real estate to work with to expand, but I don't know. I'm not an expert in that area. Construction in progress, it has picked up, and they picked up quite a bit in 2016. That's good, but they didn't do anything in 2017. So again, what's curious to know what they got going on there. Other property, plant, and equipment, it's up slightly. Okay, total assets has gone up more than double. Total debt, though, has gone up almost 3 times. So that's something to be concerned about. Whether make sure they can get their bills paid. Long-term debt has gone up quite a bit. You know, something I didn't look at up here was long-term investment, if they have any. I don't really see much there for. They don't look like they're investing in anything. You know, like for like other investments. Okay, total equity. See, it's all over the place. So that would make investors nervous. This I would not trust this one personally, but like I say, if you're looking for a longer term speculative type of position, maybe this could be worth having. Just like I say, don't know. Okay, employee benefit plan registration on the 2nd of July, and then there are a whole bunch of insider activity here. These are probably associated with regular quarterly stuff, so but I'll double check. This is an option. It's another option here, so yeah, I'm not going to go through the rest of those. Okay, so this is this is one of these where I kind of call it like Xxii, but they're definitely more risky than Xxii or 22nd Century, whatever you want to call them. I personally like 22nd Century more than Neos from what I'm seeing so far. So that's up to you if you want to hold on to them and hope that it pays off in the long run. If you're looking for more shorter term results, I don't think you're going to get it from these guys. So keep that in mind there. So I'm not going to say sell it or hold on to it. You got to decide for yourself what you're really looking for there and what you're willing to, how long you want to wait for what kind of return. Okay, the last one here, AK Steel Holding Corp. It's a mining company. That could be a good one to be in. You said this one was making you money, and mining companies right now. Now, I don't know why, but mining companies materials sector as a whole tends to be positively impacted by rising crude oil prices. Like I said, I'm not a micro expert, so I don't know what the intricate details of that is, but I do notice from the macro view that material sector stocks in general tend to do the same thing as energy, and both of them tend to move the same direction as crude oil prices. So, and knowing what crude oil market is doing, this could be a good thing. Now, flat-rolled carbon, stainless electrical steels, and tubular products through its subsidiary. Okay, if they got steels, then you got to wonder if they're going to be impacted by the tariffs. So I'd look into that. Doesn't mean they're going to be impacted at all, because they might be already getting their sources from U.S., could be South America, could be Canada, could be somewhere else. Now, you never know. The company also operates blast furnaces and electric arc furnaces. As of 31 December 2016, they had 8 steel making and finishing plants, 2 coke plants, and 2 tube manufacturing plants across states, including Indiana, Kentucky, Michigan, Ohio, Pennsylvania, and West Virginia, and a tube manufacturing plant in Mexico. Operations produce flat-rolled carbon, specialty stainless, and electrical steels that it sells in sheets and strip form, and carbon and stainless steels that it finishes into welded steel tubing. So these guys are going to be impacted by the construction industry more than likely. So, and I know that housing market's kind of slow right now, so that could be a concern there. Also, the tariffs. Find out where they're getting their steel from. And generally, just because steel, the tariffs, even if they're not really so well impacted by China tariffs, um, the uncertainty that the tariffs have caused are they have caused prices to spike in that area anyway. So, but these guys, remember, they're mining this stuff. If I'm not mistaken, I don't know. They might, or they're just manufacturing it. But now, if they're mining it, then then the price goes up. Then that's a good thing for them because it increases their profit margin. But if they're just manufacturing it, where they're buying the metals, the raw material from a mining source, and then going through their process with it and then selling it later on, and that could be a problem. But it looks like they're more of a manufacturer than it is a mining type company. So I think it'll be the latter, where they're more questionable what they're going to be impacted. Now, this looks like another high beta stock, and I can see right here 2.9. This reflects that. Pretty wild price swing, so this looks like more of a short-term kind of traders type of stock, if anything at all. They're closer to their 52-week low than they are to the high, so that's another negative thing to look at there. Market cap 1.4 billion. They're actually not that bad. Their mid cap a little more growth. If they grow a little higher, get up at least about 5 billion, they can actually make it just right into that cusp of mid cap to large cap. I don't know why they're saying small cap value here, because their market cap tells me they're more of a mid cap. Their earnings per share, they're in the hole again, but they're not very far, so that could be a positive sign. We'll look a little more. No dividend. So again, if you're a drip investor, these guys are just not the one for you. Percent held by institutions, 61%. That's not bad. Could be higher, but like I say, it gets a lot lower than that. So there is some interest there. The short interest, though, almost 25%. That's a lot. So a lot of traders are betting against this company. It looks like, or a pretty decent number. So that is a concern I'd be looking at. Okay, so they don't pay a dividend, then like I was saying, I would expect to see some kind of earnings growth out of them. There's kind of no rhyme or reason here. Like I see a negative here, but the same quarter the previous year was positive. This is down from there, this is up from there, and then this is up from there. So they figured something out there, and then they went back down. And you see, they had a negative in the first quarter, not the fourth, in the previous year. And so they look kind of unpredictable here. And the most recent, this could be factored into why they're down too, is they missed. It wasn't a huge miss, but it was still more than 10% miss on expectations. Okay, third quarter plus 23 from plus 4. That's a good sign. Expecting 21 from minus 6. That's a good sign. Plus 23 from 9. That's a good sign. 24 to 18. Now remember, they were expecting 20, and when you have a recent miss, that's a concern too. It's not necessarily a problem, because they do seem to have a pretty decent history of beating estimates, so that's good. But it's just one of those, something to watch for in the coming quarters. If it's just one miss, it's not a concern at all to me. There's probably something that could explain that. But so over the next couple quarters, over the next year, it looks like it should theoretically get something, but then it looks like it'll be flat. So And when it tapers off, I wouldn't be surprised to see the share price also taper off some too. So uh, that's something to be. That's another concern there. If they don't pay a dividend and they're not really any prospect of earnings growth over the longer period, I don't really see much to really enjoy about this company. Okay, balance sheet. Cash and short-term investments. Okay, they had a lot in 2016. They came back down to where about their normal is. Total debt, they have a lot of debt, but it looks like they're keeping it stable. They're not racking up more and more. It looks like they're just maintaining. Total equity, they went pretty far to the hole in 2015, but look like they're recovering, so that's a good sign. Yeah, I'm just going to kind of glance over this real quick. See, that's a representation of what we just looked at in that chart. So they're only 45 million in the hole now, when they were 272 in the hole the previous year, and that's a pretty nice climb. So that does look like there's a chance it could go cash flow positive, or next year. All right, they just reported earnings, and then you have a cluster of insider buy and sell activities. Take a quick look at them. This is an acquisition, but it was at $0. So it's not an open market purchase. More like it was probably part of their deal as being a part of the company. Gregory Kenny, the director. These are probably all going to be the same. Dwayne Wilson, a director, also an acquisition, like basically a free acquisition. So the company's given these guys equity for their services. That same thing going on there. Same thing going on. All right, so yeah, it looks like it's just part of the agreement they have. They have the board of directors, helping make decisions for them, and in return they're giving them some of the equity of the company. I don't know. I don't see enough with the earnings there, and then when I come into here, so I'll look at the materials sector. Materials is supposed to be a stronger sector right now. Right now they're the third strongest, I believe. Yeah, behind energy and financials. And if I spend this, okay, there's only one group, so okay, between the four groups in the materials sector and industry groups here, metals and mining is supposed to be one of the stronger areas too. Construction materials is supposed to be the strongest, plus 37% total earnings growth for that group, at least as far as S&P 500 companies are concerned. And the metals and mining companies are second at 32.7. So as a group, they should be getting some results. So when I see a smaller metal and mining type company not getting the same kind of expectation of growth as the larger companies are, that's another concern. All in all, I'm surprised you made money off that one. It looks like if you made money, I would think it would have been more of a short-term play, or you bought it at maybe one of these, maybe here in May or something, where it was at a lower point, and perhaps, I don't know if you still hold the position or not, but if you played a short-term play and were in it and you bought in at the ideal time, I can see why you made money off it. But otherwise, I don't see a heck of a lot there that really interests me at all. Doesn't look like one I would just flee from, but at the same time, I can't really put my finger on what kind of portfolio this would really be best for. It looks more like, I mean, because it has the volatility, it'd be better for a short-term trader, but the financials look like they could be more of a long-term. But yeah, they're in the steel industry, and they're not a mining company, so I mean, and they're probably gonna be impacted by tariffs, or at least the complications caused by tariffs. So I'm having a hard time really liking these guys, to be honest with you. Uh, that's your call if you'd want to hold on to these guys. But if you want something that's going to be more of a sure grower, I would stick with the larger companies, and yeah, I can always help with screening that by showing you these groups here. Uh, kind of give you kind of an idea what area to look at. Now, for those of you who might have an interest in more of this, this is how I take more of a top-down look at things, like energy sector. The energy sector is supposed to be the strongest right now in terms of earnings growth, which means I would expect the share price to grow the most as well. If I expand this, I'm going to get two different groups. Get energy, equipment, and services, and oil, gas, and consumable fuels. Now, as you see, the total earnings added up, it's not so high with the energy, equipment, services, and I think it's because there's only one company in it. While the brunt of the group here is in this oil, gas, and consumable fuels. Both look like they're expected to get really good earnings growth, though, which means I would expect to get good share price growth as well. So as a growth type investor where I'm looking for share price movement, this is where I would look. And I already have a company in this group. I own Phillips 66, but just kind of follow along here with the macro look at this. I would say maybe have an interest in this energy, equipment, and services. Okay, I forgot it breaks down further before I get to the one. Now, this is actually, it says negative, but it's actually supposed to be a positive. It's just I got to fix my formula so it reflects that this is a positive result, not a negative. I just haven't determined how I want to do that yet. But this is in the hole, so this is one I probably wouldn't touch. Just as part of my own. This is Helm Rich and Payne, HP. Just the fact that their trailing 12-month earnings is in the hole on a non-GAAP basis, I probably wouldn't buy them just yet, personally. So I wouldn't look at them, but they could be a good explosive one based on that. I would be more interested in this group here. NOV, Novell, or I forget the name of that company. Baker Hughes, GE, FTI, again, I forget what their company name is. Halliburton and Schlumberger. That group there, that's group of 5, looks like it'd be the group I'd have the most interest in looking at if I didn't already have energy sector position. Now, out of those 5, again, I don't play with companies that are underwater, so negative 26 NOV would be out of the question for me. So it'd be down to these 4 here. And out of these 4, Baker Hughes looks like it's got the strongest prospect, but Halliburton and all 4 of them are pretty decent. They can theoretically get you S&P 500 beating performance over the next year, possibly. That's assuming the price is not already baked in too much, but again, that's where you do your diligence and actually research this stuff. But so just me, these are the 4 I would actually look at, and then I would go into my Ameritrade account and actually pull up all the same details about each of those companies that I was just showing you about the 4 that I was just looking at for Ronica. So it's just the way I run things. There's so many different ways you can invest and look at things. pick whatever system works for you. I say I have a more of a macro view, and it does take more work to get to what I have here. Uh, as I'm much more into this than your average investor, and uh, now I keep the whole entire index here, and I keep a record of when their previous and next earnings are, what they reported 5 quarters ago, what their last 12, what their last 4 quarters were, and what their next four are supposed to be. And so I know what each company is supposed to be doing over the next year, and then I can get a collective data from it, from all these different areas here. So that's kind of an idea of how I work with this. Basically, that earnings tab there is the foundation of everything else I have in this spreadsheet. And then this is how I run my analysis. I can get the numbers put together, and then I go, okay, what is this information telling me? What does it add up to? Or, there's got to be some kind of clues it's giving me. And I like to actually look at this stuff and figure out what kind of hints it's giving me and make my decisions based on that. So, alright, like I said, this is my method here of compiling all this data and researching all that is not going to be for everybody. But if you want to sure bet that your money's going to more than likely get you results you're looking for, maybe not knock it out of the ballpark kind of results, but still plenty good results. You can always go and get into doing this kind of thing too. It does take time to build it up from scratch, but once it is set up, it's not as difficult to maintain as you think it would be. It's the first, maybe the latter part of the first month of each quarter. So like July, August, September is a quarter. It's third quarter. The late July usually would be the busiest period where all the companies reporting updated earnings at the same time, and so on. Yeah, it can get kind of heavy there. But again, you can even scale this down. Maybe if you're only interested in a certain sector, try doing something like this. Just get a list of all the companies within that sector or industry or whatever that you're interested in, and get a real comparison of what each of these companies is expected to do, what kind of dividends they pay, what their financials all look like, what do they have going on. Because a lot of times the company that looks interesting to you might not be the right company for you, or it might be the right company, you're just interested at the wrong time or something. You never know. So anyway, I hope you enjoyed this viewing. Let me know what your thoughts are. Thanks. Bye.